Hey everyone. So if you're a Canadian investor and you've seen any of my other videos on this channel, you would have heard me raving about HDIV.to, which is one of my go-to fundamental income plays as a Canadian. But in a fund like HDIV, there's very little US market exposure. And as we all know, the US market is king when it comes to the stock market. The most liquidity, the most depth, the largest selection, and on and on and on. So as a Canadian, how do we get income exposure to the US markets? Well, if we are focusing on the S&P 500 specifically, you got USCL and HYLD. Now, obviously, there are many other choices from several fund providers, but as you may or may not know, we go for max extraction on this channel, Mr. Monopoly Man type vibes. And so leverage is key, especially when it comes to income fund returns. Subtle leverage can make or break your income fund returns over a long enough period of time. So today we are breaking down the battle between USCL and HYLD. Two funds, two providers, head on. So give this video a like, subscribe to the channel, and let's get into today's content. Now, for those of you that don't know me by now, hi, I'm Patrick. I've been an investor for over a decade, an option seller for about 7 years, and I've been investing in crypto for 7 years as well. I've grown my portfolio to over $250,000, and I run a little school community by the same name as this channel. This is the best way to support the channel, so if you want to go check that out, link is in the description below. So quick caveat before we get to the meat and potatoes of the video, I personally do not own either of these funds in my portfolio as of this moment. I mean, definitely considering it in the future, but my main priority as of this moment is total return performance. And unfortunately, these Canadian covered call ETFs for US markets are underperforming my foundational income holding, that is HDIV.to, and it's a pretty large margin as well. Not to mention my heaviest weighting in income funds at this moment is MSTE.to, which we all know is super volatile. So when it begins to take off with Bitcoin's appreciation, its returns will far outpace what HYLD or USCL will be able to offer. Now onto the good stuff you're here for. Remember, my risk tolerance is stupidly high. I am a crypto investor at heart at the end of the day, so my portfolio will probably look a lot different than yours will. But that's okay. That's the beauty of investing. Now onto the stuff you're here for. So both USCL and HYLD used covered calls to boost distribution yields way above plain vanilla S&P 500 ETFs like VIV or VOO, and more frequently, but they're structured differently. One is more of a direct S&P 500 play, the other is a leveraged fund-to-funds approach. Now, which one is better for income? Total returns, fees, risk? Well, as you guys know, I love charts, but before we get into the charts, let's look at the similarities and differences between the two fund structures. So first, let's talk about HYLD, Hamilton's Enhanced US Covered Call ETF, the ETF provider who also manages HDIV.to, my favorite fundamental income play as of the moment. HYLD is a fund of funds that holds a basket of US focused covered call ETFs. So it's basically a covered call ETF of a basket of covered call ETFs. Here, HYLD aims for a sector mix similar to the S&P 500, just not a direct mirror of it. And it uses a modest leverage of 25% through cash borrowing, not derivatives. Between the two, HYLD is the fund with the earlier inception date, so it has more historical data to work off of. Current annualized yield is around 12 to 13% and focuses on providing attractive monthly income and aims for some long-term capital appreciation. Now, USCL is Global X's enhanced S&P 500 covered call ETF. It directly applies a covered call strategy on large cap US equities, tracking an enhanced version tied to the S&P 500. There's no fund to funds layer here, just straightforward exposure to the S&P 500. Uses approximately 25% leverage to boost income as well, and yield is often in the 12, 13, 14% range received through monthly distributions, and this fund has a focus on high income and large cap stability. Now, both are also listed on the TSX, which is great for Canadians looking to avoid direct US withholding taxes in registered and non-registered accounts. Now, if we were to put these funds into like a Venn diagram type of comparison, there would be more that these funds have in common than they do not. I mean, after all, they are chasing the same markets here with just small deviations here and there with the strategy. So remember, when we talk about the differences in this next part of the video, they're not massive. We're just being a little nitpicky here if you want to get very focal on your choices. Now, in terms of similarities, both target high monthly distributions. US large cap exposure with covered calls to generate extra premium. 25% leverage in both funds, and they both sell covered calls on around 50% of the portfolio, give or take a few percentage points. And obviously, if you don't know by now, covered call ETFs suffer in strong bull markets as you remove that right tail risk of the normal distribution of stock gains, and so both do underperform in these conditions similarly. Now for the real differences, HYLD is a fund of funds, so it holds multiple covered call ETFs, and so in a way it is indirect exposure to the S&P 500 index by using other covered call funds to try and mimic the index, whereas USCL is just a plain old 25% leveraged S&P 500 covered call fund. Now fees. These two funds differ in fees, and to be honest, the water gets a little murky here because I can't get an accurate management expense ratio for HYLD because you pay a 0% top level fee for HYLD itself, but instead you pay the individual ETF fees from the basket. So that means you have to take each management fee from all of these covered call ETFs and average them out depending on their weighting in the basket. And honestly, I couldn't be bothered, so I asked Grok instead. Now, Grok told me that HYLD averages around 1.2 to 1.3% MER, while USCL has a 1.6% MER. So based off of these numbers, HYLD does slightly win here if Grok is correct. Now, Grok could be completely wrong here, as I've often caught it being wrong when it comes to financial data. So if you have different numbers, please let me know. Well, please let everyone know down in the comments. If I were to guess, I would have actually thought USCL would have lower fees than HYLD since there's no fund of funds drag and that extra layer of complexity. But let me know if you find the true numbers. Now, from a volatility and risk standpoint, both are a tad risky since they employ a leverage mechanism in the fund, which amplifies both gains and losses. HYLD is more of an indirect fund, so a slight extra layer of risk from holdings changes, and USCL is a direct mirror of the S&P 500, so potentially a little more transparent. However, as you will see in the chart soon, USCL actually has slightly more volatility in total returns than HYLD does. So in a way, HYLD is a more stable fund. Now, I personally prefer a direct mirror fund, so in this situation, I would probably choose USCL over HYLD. And lastly, the size of the funds. HYLD is the bigger fund here, boasting a $1 billion in assets under management, while USCL is a quarter of the size, coming in at $257 million of assets under management. So if this matters to you, HYLD is the clear winner here. Now to the chart. So starting total return performance from the latest fund inception, which is USCL from July 5th, 2023. So about 2.5 years of data so far to compare. And as you can see, total returns as of today are literally neck and neck. The total returns from USCL's inception is identical. However, along the way, you can see USCL deviates with spikes of more volatility here and there. And I would assume this has to do with either the percentage of covered call exposure at these given points in time, or simply the fund structure of simple S&P 500 mirror versus fund of funds. But overall, total return to this day is exactly the same, which you often do not really see. And of course, no Apex Wealth Collective Income Fund comparison would be complete without the golden standard HDIV.TO. As you can see, HDIV.TO far outpaces the returns of both HYLD and USCL, which again further solidifies my stance in owning HDIV over both of these. Now, what do you think? Are you holding HYLD or USCL in your portfolio to get your US market exposure, or both, or neither? Drop your pick in the comments and tell me if you hold either. And if you don't want to converse, drop a tongue out emoji in the comments to let me know you made it this far in the video. Finally, to round it all together, the bottom line is this: neither is really better overall. It just depends on your personal preference. Both of these funds are powerful tools for Canadian income seekers, especially in registered accounts. I would say choose HYLD if you value more stability, and USCL if you value more exposure. But make sure you always check the latest fact sheets on hamiltonetfs.com for HYLD and globalx.ca for USCL. Remember, yields and performance always move with markets, so these returns can always change. And now, if you have stuck around this long, go ahead and catch another one of my videos right over here, or check out my channel over here, where you can take a look at all the other content I have to offer about investing and my personal investing journey. And that's all for me today. I'm Patrick with Apex Wealth Collective. Take care. Thank you for watching, and I'll see you guys in the next video.